Hello class, welcome to the second lecture video here. Let me share my screen and we'll get started. In this video, we are going to finish up chapter 3. We'll talk about adjusted trial balance and then some closing entries. Okay, so in chapter 1, we made a trial balance. Okay, normally that's made at the end of the period, you make a trial balance. Then you make your adjusting entries, and then you'll make what they call an adjusted trial balance. Just repeating a lot of the steps. Okay, and from that adjusted trial balance, then now we can make our statements. Okay, we can make our income statement. Remember that it's prepared from the revenues and the expense accounts. Revenues minus expenses equals net income. After we get net income, we use that in dividends to make our retained earnings statement, to find a new balance in retained earnings, which is a balance sheet account. Then our balance sheet is prepared using that new, all the numbers that were in our adjusted trial balance, only replacing the new retained earnings figure in there and removing the expenses and the revenues. It's all well and good. As you can see here, if we have an adjusted trial balance, all this stuff, and then we get down here, we have dividends, revenues, and expenses, or income statement accounts. We find our net income, move it into retained earnings, plus the dividends, and then on to making the balance sheet. Failure to record the adjusting entry for annual depreciation does what? Remember depreciation? That is going to be an expense, but it doesn't say anything about expenses or income on there, so we can, it has nothing to do with revenue, we can get that. Depreciation also creates a contra account of accumulated depreciation, which lowers an asset. So if we forget to put in the adjusting entry, we are not going to lower our assets as much as we should. So in turn, our assets are going to look higher than they are. We will overstate our assets. Right, so finally now we made our statements, we went through, we've done all that in chapter 1 from our trial balance there. Now we have all these revenues and expenses just kind of floating in nowhere. We put them on the income statement, but we need to do what we call closing entries. All temporary accounts, that is all revenues and expense accounts, they're considered temporary. Anything that goes on the income statement is temporary because we will close it out after we create the income statement. We have to close it out because we need to move it into retained earnings. Okay. They're never going to have a running continuous balance. But stuff that's found on your balance sheet, all of those accounts, they are called permanent accounts because they are always there. They never go away. The balances are going to fluctuate, but they're always going to be there. So the final thing we need to do is close out all these temporary accounts. To do this, we do it in 4 steps here. We close revenues to income summary, and income summary is just going to be an account. It's just going to be like a holding account. We're going to make it up for 3 journal entries, and then it's going to be gone. Then we close expenses to income summary. Okay, so once we close all out, the income summary now, the amount that's in that account should match our net income, which is revenues minus expenses. Then we move that income summary into retained earnings. We close it out into retained earnings. And then finally, if we have any dividends declared, we need to take them out of retained earnings as well. You can read through why it's so important, but basically you don't want to have your revenues and expenses carried to the next period because they are period items. That could really upset how your income statement looks. So here we go. We show the balances. We have some revenue, expense, 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 retained earnings, and dividends declared. All accounts have their normal balances. So we are going to close it off. The first thing we do is close revenues. Okay, interesting. We'll go back to this one. Here it says the closing the process of 4 steps within the question doesn't even walk you through those 4 steps. Okay, because the simpler way to do it is see, since we're putting revenues in the income summary and expenses in the income summary, and then income summary into retained earnings, it's been more effective and cost efficient now to close revenues to retained earnings, close expenses to retained earnings, and then you skip step 3 because you have created no income summary account. So that's the way it's showing you, that's the way we're going to do it. So here, step 1 is to close revenues. We had this much revenue. It is normally a credit balance. To close it out, what we mean is we're going to make that balance go to 0. So we take away a 2,174,000 credit balance. We debit it, which, as you can see, increases our retained earnings. When we do expenses, expenses have a normal debit balance. So to make them go to 0, we just need to make a credit entry for the balance to balance them out at 0, close them out. And the difference debits retained earnings or makes it go lower. Then to close dividends, dividends are a normal debit balance. To make them go away, make them go to 0, we need to credit them, which in turn is going to cause a debit to retained earnings or lower your retained earnings, that equity account. Okay, these are just taking the whole amounts and just doing the exact opposite of how we put them on to close them out and make them go away. And that is the end of our accounting cycle. Okay, now you're ready to watch chapter 3, handout 2, and you should be able to get through your homework assignment after that handout. Best of luck. I will talk to you again soon.